First, I'll introduce you all to today's webinar and what we intend to do. Okay. Welcome everyone, and thank you for joining us today. This session is designed for serious market participants who want to move beyond opinions and indicators and instead understand how technical analysis and quantitative thinking come together to build robust trading systems. Today's discussion will focus on practical framework, discipline processes, and how professionals actually approach markets in the real world. To guide us through this, we are joined by someone who lives and breathes structured market analysis, Mr. Vivek Jain. Mr. Vivek is the founder of Decode Charts and our knowledge partner for this session. He is a certified financial technician and has successfully completed all 3 levels of CMT Chartered Market Technician program, reflecting deep expertise in technical analysis. In June 24, he was also awarded EPAT Certificate of Excellence in Algorithmic Trading by QuantInsti. With over a decade of investment experience and more than 5 years of active trading, Mr. Jain works at the intersect of technical analysis and quantitative methods, designing, testing, and refining systematic trading strategies with a strong emphasis on discipline and risk control. We are excited to have him share his insights and practical experience with us today. So welcome Vivek to the session.
Right. So good evening, everyone. Welcome to today's session and thank you for joining us. Before I begin, I'd like to thank Sovit sir for the warm introduction and for giving me this opportunity. Sovit sir has been my mentor, and under his guidance, I started learning AFL coding in 2023. That journey helped me and motivated me to clear my CMT level 3 and led me to learn Python in depth and its application in algorithmic trading. So over the years, while building trading systems, I have found Python to be absolutely indispensable, not just for automation, but for clarity, structure, strategy design, testing, and decision making. Python also allows seamless integration with broker APIs, enabling the development and deployment of complete algo trading setups. Today's session is an introduction to Python and the strategy design workflow, which I will demonstrate step by step. This session will be especially useful for traders, analysts, and students who want to move from discretionary analysis toward a more systematic and data-driven approach. Even if you have no prior coding experience, this session will help you build the right foundation. With that, let's get started by first understanding why Python has become the backbone of modern quantitative and systematic trading. Sir, I hope my screen is visible.
Yes,
Yeah,
visible.
Vivek, we can see your screen.
So, sir, should I start or should I wait for the presentation?
The presentation we can see, you can start.
Okay. So the session is on Python for trading from idea to implementation. Before beginning the session, general disclaimer, the strategy demonstration and backtested results shown in this session are for educational purposes only. Backtests are based on historical data and assumptions and may not reflect real market conditions such as slippage, liquidity, transaction cost, or execution delays. Results are not guaranteed and past performance does not indicate future outcomes. Trading and investing involve risk and participants should conduct their own research or seek professional advice. This presentation does not constitute investment advice, portfolio management, or a recommendation to buy, sell, or hold any security. So thank you, and I'll just begin. So quick orientation takeaways for today will be, we'll understand and learn why Python is the core of data-driven trading. We'll start off with a data set. We'll fetch and clean and validate market data before our analysis. We'll build technical indicator-based strategy and generate signals. We'll measure the performance through returns, volatility, and drawdowns. And finally, we'll compare the strategy outcomes with the underlying asset for insights. One second. So why Python for trading? So Python is a modern high-level programming language, often called Excel on steroids, because it handles everything Excel can and do and much more faster and smarter. It's a general purpose programming language. It's an open source and free. So anybody can download Python and can start coding and trying all these things. Being an open source, Python also has a lot of libraries that we can make use of, which I'll also discuss a little briefly later. So, if Excel, just to give you an example, if Excel starts hanging and you load, say, 20 years of data, Python doesn't even blink. So that is how swift and fast Python is. Python ease of use. It is a simple, readable, and beginner-friendly language. No computer science background is needed. Feels like writing logic in plain English. A simple example can be like price greater than moving average, buy. So it is as simple as that when it comes to its syntax. It has a huge community, tons of ready-to-use code, and libraries are built for finance, as I told you. So there are a lot of libraries that are open source, and we can, capitalize on that. Like there are libraries like Pandas, NumPy, SciPy, and all these libraries we can use as per our use cases. So it's a most popular language for data analysis, finance, AI, and quant trading. It is backed by global firms from hedge funds to fintechs and investment banks, and it is free and open source and continuously evolving. So it's not that the libraries that are there in Python, which are open source and which we can use, they're always updating it, and the codes and the people are always making new libraries which we can make use of. So now the final question is that why Python for finance? So firstly, I told you it handles massive data sets and time series effortlessly. So like a 20 years backtest that you do on Python will be so seamless and swift. Today also I'll demonstrate you. It makes Python very intuitive and very easy to apply and implement. It integrates easily with APIs, Excel, SQL, Bloomberg, NSE, BSE data and brokers. So once we make a strategy and then say if we wish to deploy it, then obviously we will have to connect it with the brokers. So Python gives you very easy ways to implement and integrate it with REST APIs of brokers so that you can make your system go live. It can automate tasks like portfolio tracking, signal generation, and reporting. Now, some of the core benefits of Python are, number one, I told you it is automation. So it replaces a lot of manual Excel routines with one-click scripts. So like we can also make strategies using Excel, and I have done it a lot of time. But when you are downloading historical data of say 10, 15 years, and when you're testing it on multiple tickers, then even Excel gets it's not very fast, and sometimes it also gets it hangs up. So this way Python is very seamless and it replaces all of the tasks that we do in Excel in a much more advanced and swifter way. Obviously, I told you that we can build analytics, like we can build dashboard, risk metrics, and visualizations so that we can understand the strategy either if we are testing it in live data or maybe we are forward testing it. So we can do the analytics part, and as per the market, we can check it whether everything is going fine or not. Backtesting, again, we can test strategies over years of historical data, and it is very scalable. You can move your spreadsheet to a full trading system in Python. Integration is seamless. You can connect it with the trading APIs for live execution with almost all the brokers in the world. For quantitative and systematic traders, design, test, and refine trading models objectively is one of the use case. We can combine statistics, indicators, and machine learning in one ecosystem. You can backtest thousands of trades in seconds, build data-driven conviction, not gut feeling. So if Excel made you analyze markets, Python will make you understand them systematically, scalably, and scientifically. Like in trading, we deal with data, logic, and repeatability. Python lets us convert trading ideas into rules, test them, and run them consistently without emotions. Instead of guessing whether a setup works, Python tells you whether it worked or not. When it comes to the libraries, so you don't reinvent the wheel. Someone has already coded it, tested it, and shared it, and we just have to use it. This is the same language that is used by retail traders, and it is also used by hedge funds. And this is why it is so powerful. You can just pull the market data, generate signals, place trades, and create a report all in one workflow. And finally, the best part is that you can convert your trading logic into rules. So decisions are based on data and not emotions. Now, when we talk about backtesting and building a quantitative strategy, there are various steps involved in Python. So I'll just go through the 9 steps, which are the core steps. Firstly, we will have to import the necessary Python libraries. So as I told you, Python has tons of libraries. So whatever our use case may be, we'll import only those libraries and we'll start working from there. Once we load the necessary Python libraries, then obviously we'll require data. The data will be required because we'll be reading the data, and from there we'll be building our strategies. So in Python, we can read a data from a .csv file. We can read a data from Excel file. We can even download data from third parties. Everything is possible. So we fetch the historical data, for an example, from a CSV file. And then after that, once we fetch the data, we will do some sanity checks, the integrity test of the data, whether the data is fine or not, whether all the columns and all the cells they are not empty. Because if a data set is missing, then we need to take care of that. So Python gives you seamless ways to control your data set, and we can do all that, like filling up the data, or any missing data is there, we can remove it, or we can overwrite it, and all these things can be done. So once this data set is cleaned, we can obviously filter the data set as per our specific date range. For an example, if we are testing on, say, 20 years of data, and say the first 15 years of data we would like to keep for testing, and the next 5 years of data we want to keep it for forward testing, so we can do that. Once we download the data, we have to convert it into a data frame. Data frame is nothing but it is just like Excel rows and columns. And when we talk about any strategies, we always talk about time series data. So time series data is a data that is where the index is actually the time component, and the columns like open, high, low, close, and volume are the different columns. So whenever we download a data, even from internet or NSE, then you will always see, generally it gets downloaded in a .csv file, and you'll find, rows. The rows are index are all dates, and the columns are open, high, low, close, and volume and all. So we have to arrange that data in a data frame, and then we have to make the date specifically an index so that we can refer to it. Once that is done, and once we have checked that the data set is now clean, then after that confirmation, we'll start building our strategy. So as a technical analyst, when we build strategies, we often use many indicators. So once we say decide on a hypothesis that we'll be building a strategy, say on a moving average crossover system, or maybe we are building a strategy on momentum, right? So we can use all these indicators like ROC, moving averages, EMA, RSI, Bollinger Band, and all these things. So the next part would be obviously to compute those technical indicators that we would be using in our strategy. The example that I'll be demonstrating you, will be calculating ROC, and we'll be creating a long only strategy with that. So once the technical indicators are computed, then obviously the next step is to generate a buy and a sell signal, which is based on some condition. So that the condition could be any, right? The condition can be single, the condition can be multiple. So we can the condition of buy and sell can be exactly opposite. The condition of buy and sell can be completely different. So all these things can be done. So once our logic is clearly placed, and once when we talk about say quantitative systems, so the logic part has to be very clear, and it should not be subjective. So a simple case may be that we compute two moving average, say 50-day DMA and a 200-day DMA, which will when the 50 MA is say above the 200 DMA, then we say the trend is it's an uptrend, and then we can put the condition like that we buy, because the probability of prices rising up are higher. So we can build all these strategies. We can build mean reversion strategies on a Bollinger Band, where we take a mean reversion trend when the price hits the lower band, and we do the opposite when the price hits the upper band. So once we compute the technical indicators, we can go further and we can generate the buy and sell signal. So we will have to clearly define the logic here. The logic can be as simple as that when the close is greater than the moving average, we buy, and when the close is below the moving average, we sell. Or maybe it could be like when 50 days crossing above the 200-day, we buy, else we sell. Once we do that, then we will in Python we can plot the signal chart, and where we can actually see it on the chart where how are the signals generated, whether they were generated correctly or not. So once the signal is generated, next thing that we need to do is that we need to understand how long that signal is going to hold. So I'll come to that when I'm going to show you the Python execution, so that you'll understand better. Once the signals are generated, once we have a clean buy and sell signal, then after that we'll calculate the asset returns. So the asset returns is say for an example, we are building a strategy on say any particular stock, say Hindalco or Tata Steel or Infosys. So we'll calculate the buy and hold returns of Infosys, and we'll also calculate our strategy returns on Infosys, on the Infosys strategy, so that we can compare both the strategies in one output as a cumulative equity curve. That will give us a clear picture how the end result, whatever the final output we generated or the return we generated, we can know more about it looking at the equity curve. So we generate the strategy returns, the asset returns, we compare it, we plot it. And finally, once we are done with all this, then Python gives us a lot of resources. As I told you, we can dive more deeper into statistical analysis, where we can check all the performance metrics like Sortino ratio, Sharpe ratio, Karma ratio, maximum drawdown, annualized return, CAGR, and all these things. And then we can actually compare our strategy with the asset, so that we can understand it a little more deeper. So I'll be showing you all these 9 steps, and I'll be generating the output from all of these, and I'll be showing how the output looks like. And finally, we'll also come down to our strategy returns and comparison, and then finally we'll go a little deep into the statistical analysis of it. So say once we so these are like some of the examples that I've put in, which I'll also show you in the Python file. Like this was the output of the simple closing prices of Tata Steel. we'll be testing time period. We are testing on a 10 period horizon, starting from 2015 to 2025. So this is how the line chart looks for Tata Steel. I mean, this is the output. Since we will be working on a ROC based strategy. So I've just plotted the ROC below the line chart to give you the output that Python generates. So this is the output of the closing price, and this is the subplot is for ROC. Now, as I told you, we can check our signals. So this is for a particular time period. This is the asset, and these are the signals that we got. The green being the buy signal, the red is the exit signal, and this is the ROC that has been plotted. So you can check your buy and sell signals from here. Now, after that, what's also important is that once we are in the buy position, how long, once we enter the trade and we take a buy, and before the next exit, how long we were in the position. So when I say position, I mean how long we were holding that stock once the buy was generated. So this is the position plot. And in quantitative trading, when we are coding, so there's a general rule. It is like when we say 1, it is long. When we say -1, it is short. Or when we say 0, it means exit, or we are not holding the trade anymore. So over here you can see that 0 is there, and it's a long only strategy output. 1 is there, right? So these are this axis is for the years. So when we have generated a buy signal, and when we are in a long position, then you can see that it has gone up, right? So this is the position. These are the position where we were long. Since it's a big data, so many times you can see these black periods. These are nothing but you can see, these were the areas where we got a lot of whipsaws. Right. So this was the area where we got a lot of whipsaws. So you can clearly see that, these are the signal, the position plot. These are the places we were long, and these were the places we were out of the trade when it is 0. So once we do all this, once we check the positions, we also checked how the signals got generated. After that, obviously, we'll have to calculate the returns of our strategy. So I'll come to this plot again. So what we do is that when we are calculating the returns, we can also plot the cumulative returns. And this is the output of the cumulative returns. So this blue one is the asset. I mean, this is nothing but the Tata Steel buy and hold returns. I mean, if you have, say, from 2015 to 2024 end, if you would have just holded Tata Steel, then how much return you would have got. And this is the strategy on the Tata Steel asset. So if we would have run our strategy, then how much return you would have got. So these are the equity curve gives you a very good comparison of how we generated and reached here, right? So we can see, this equity curve gives us a lot of idea about how the strategy behaved in our backtest. So you can see in this zone, our strategy was outperforming, right? But it started to underperform here. It was underperforming all this while, and then again it started to outperform and started to underperform here. And in this zone again, it was outperforming. And from here, maybe there was a sharp pullback or the market was not very healthy. Strategy started to decline a little. So it gives you a very clear view of how your strategy would have performed in the backtested period. And when you are comparing it with the asset, say you build a strategy on Nifty, so you can compare it with Nifty. Right here, we are comparing it from Tata Steel because we are only trading Tata Steel here. So it gives you a very good idea about your equity curve. And obviously, we would always try our best to make our equity curve look smoother. And that is how system testing is all about. So now let's, whatever I've mentioned and whatever I've showed you, let's run this on Python. I'll be running it live in front of you so that you can actually have a very intuitive understanding. And before moving to it, I'm just showing you this plot. Like this is nothing but the daily percentage change of the asset versus the strategy. So I've overlaid this and it gives us a very good idea about the daily volatility. So you can see like this is the blue one is for Tata Steel and the orange one is for the strategy. And you can see that the strategy returns, daily returns are less volatile than the asset, right? So you can see Tata Steel, is very volatile at many places, but our strategy is not that volatile. So we can see that the strategy is like pretty, it's much less volatile than Tata Steel. So this gives us a visual idea about the daily fluctuations that we might encounter. So now let's start off with Python, and I'll be covering all the steps here. So like in general, when we talk about quantitative trading strategy, uh, I think there are 5 key areas which needs to be covered. First is the hypothesis, which is nothing but you should have a testable idea in your mind. Maybe it could be anything. It could be an idea that you have read on a book. It could be an idea that you have seen, or maybe you went to a seminar. From there, you learned something, and now you want to test it. So that becomes a testable market belief, and that actually becomes our hypothesis. So you should first have an idea what you want to test. Once you have an idea, then you can think. Obviously, you have to think about on what asset you need to test that. Once this part is clear, like then we go for the data preparation, which is collecting, cleaning, and validating historical market data. Only once the market data is validated, it is cleaned, we go to the next step, which is the rule formalization. So rule formalization is nothing but we compute our technical indicators and we generate signals with precise entry and exit rules. Once we do that, then we do our back testing. We test the rules on the past data with realistic execution assumptions. And finally, we evaluate and assess the performance, risk, drawdowns, and robustness of our strategy. So we'll be cover all these things now. So see, initially, we have to, in Python, you have to import few things. So I'm not going too much deep into the coding part of it, but I'll intuitively tell you the idea behind it. So what I'm doing is that I'm not just running the code right now. So we import these libraries here, right? Then what I'm doing is I'm just reading a CSV file that was stored and I'm checking. Now I'll be doing some sanity checks here. So firstly, I'll be checking that the minimum, what is the minimum timestamp? So the data starts from say 2015 January and the data ends at 2024 December. So after that, once I'm okay that this is the data set that I want to work with, then we have to check various things. So like I'm using this just to check that there are no particular cells which are blank. So when it say false, it means that all the cells have some data in it. So in short, we can say that close, high, low, open, and volume are all filled with data. And this check is essential because we don't want any particular row or any particular column to be empty. We can also check it like this. So it give us an output that is null is that it is not blank. So close is not blank, high is not blank, low is not blank, open and volume is also not blank. So we can move ahead and we can just do a quick check. So basically we have 2,466 rows. So, it's the data set is like this. Like this is the date. These are the dates. And these are the columns. So open, high, low, close, volume. So it's like that. This particular day has the open, high, low, close, and volume. And this particular day has this. So in total, we have 2,466 rows on which we'll be doing our backtesting. So from here, we can judge that the data is fine, and we can move ahead with our strategy. So obviously, when we are building a strategy, like in this case, I'm building a strategy on Tata Steel. I have selected Tata Steel because Tata Steel is a very volatile stock. So it can it has a series of uptrends and downtrends, and we can have a good picture of an idea when we are going to test it. So firstly, what we are going to do is that we'll be plotting the time series line chart here. Whatever data we read, I'm just plotting it here. So this is how the line chart looks. So this is like 2015. This is where Tata Steel started. It's from the start of our data set here, and this is the entire period. So it was up here, it was down here, right? It was up here, it was down all this way, and it was up here, and then it was a down. So you can see that it covers a lot of regime, right? So we'll be testing here. So once we plot this and once we can see that the line chart looks clean, we can go and compute our technical indicators. So over here, what I'm doing is that I'm using a logic. I'm using a indicator called ROC. So just to give you a brief idea about ROC, ROC stands for rate of change. It's a momentum indicator. It measures how fast price is changing compared to a past value. ROC tells you the percentage change in price over a chosen look back period. So in this case, the look back period that we have taken is 20. And how do you interpret ROC? You interpret it like when ROC is greater than 0. So price is higher than n periods ago. Momentum is positive. It indicates a bullish pressure. When ROC is above 0, it tells like price is moving up. When ROC is below 0, price is lower than n periods ago. So momentum is negative. It indicates bearish pressure. And say when ROC is equal to 0, we can say it is like a neutral signal. So what I'm doing is that I'm calculating ROC here. So I define ROC by close divided by the close of the n periods ago, -1 into 100. I'm just normalizing it and then printing the values. So you can see I've just printed the values of the end of the data set. So you can see that in many places ROC is positive, and in a lot of places ROC is negative, right? These are the closing prices of Tata Steel. So ROC calculation is done. Now for the entire 10-year, the ROC calculation is done here. Now what we are going to do is that we are just going to plot the ROC and the price chart to have a better idea. So these are nothing but the plotting codes that I've done. I have customized it so that it looks clean, and I've labeled it properly so that you can understand it, right? So this is the date. The x-axis is the date, right? Over here, which is common. This is the line chart of Tata Steel. These are the prices on the y-axis. This is the ROC that we calculated and we have plotted it now, right? So the middle line is the 0 line, right? So we can see that ROC keeps fluctuating, right? On an uptrend, it is hovering around above 0, and in a downtrend, it is mostly below 0. So this is what we are doing. So our signals are very simple. We will buy when ROC crosses 0, otherwise we exit. This is our long only strategy. So now I'm applying our strategy rules and I'm generating the signals. So I've applied the strategy rules here, and I've also calculated Tata Steel percentage change return, which are daily percentage return. I've also calculated the strategies written here from the signals. And now I'll be plotting the chart and the indicator with the positions. So now the signal got, all the signal got, captured, and this is the line chart. This is the ROC, and these are the signals that I also showed you in the presentation before, right? So all these places where it is at 1, we are long on the asset, and all these places where it is 0, we are not long on the asset. So simply this is buy and this is exit, this is buy and this is exit. So we keep on repeating this. We do the backtest from here to here, and then we'll see how the return looks like. So I have also generated and plotted the signals on the chart. So you can see, at these places, at this place, we got a buy signal here, right? Because ROC was going up. And it kept us long for this entire period, but gave us a sell signal here because ROC came down. So it kept on repeating it. And you can also see at this place, it was a long uptrend, right? And ROC was above 0 in all the spaces. So it gave us a buy signal here, but a sell signal here because ROC touched 0 here. So we got a sell signal here. Then we were long on the asset, and then we got finally a sell signal here somewhere because it touched it. So many times, it was able to capture, but it also gave us a lot of whipsaws here, right? So this is how we can, interpret the chart and if the signals are making sense to us. So now I'm just plotting both the equity curves. So what I'm doing is that whatever PCD percentage returns or the daily returns that we have calculated for the strategy and for the asset, which is Tata Steel, I'm just doing a cumulative, multiplication of it to arrive at a cumulative equity curve. So this is how the equity curve looks like. And in the previous example also I told you, like this is the equity curve, this is a comparison. So, we started off with 1 and the strategy ended somewhere here, which is just below 4, right? And the Tata Steel buy and hold fetched us somewhere around 4.75. So this simply means that the buy and hold returns, generated a growth of 4.63. So like for an example, if we would have invested 1 lakh rupees, we would have fetched 4.5 lakh rupees, right? 4 lakh 60,000, 63,000. And our strategy gave us, say, so close to 4 lakhs. So we multiplied the money in buy and hold by 4.5 times. And we multiplied in our strategy, it was like 4 times. Now, I mean, by this, our strategy doesn't look that great. But over here now, what is important and where Python really scores is that we can go deep into our analysis and we can do the statistical analysis of our strategy and the returns, so that we can have a very good comparison on the risk adjusted matrix, and we'll see how it compares. So over here, we got a good picture about the places where strategy was outperforming here, underperforming here, then again outperforming or at par with the asset, underperforming here, and then underperforming here. You can also check the daily, you can plot the daily returns together. So this is what I've done. I've plotted the daily returns together, and you can see that the strategy is looking much more or less volatile than the asset. So now, we'll move on with our statistical performance. So I'm just running performance here. And what I've done is that I've first I've done the matrix calculation for the strategy returns. So it shows us the start date and the end date here, the total months. We are testing on 117 months. The annual returns is nothing but the CAGR here. Cumulative returns is the total return. So it gave us a return of 290%. Annual volatility is standard deviation. Then you can check all these metrics: Sharpe ratio, 𝐸 ratio, stability. Maximum drawdown is minus 44%. And now we'll also see how much the buy and hold maximum drawdown was. So you get all these strategy metrics here: omega ratio, Sortino, skew, kurtosis, tail ratio, and daily value at risk. Then you also the plot, the cumulative return plot is here. The rolling Sharpe ratio for 6 months. What was the rolling Sharpe ratio of the strategy? This is the underwater plot, shows us the drawdowns. So from here we can see that it shows the 40% of maximum drawdown. In some cases it was like 20%, then it recovered. Then 40%, again it took some time to recover here. Then again it was like 32%, it recovered. So you can, from the drawdown underwater plot, you can make a good sense of how the strategy would have behaved. Now the same thing we are doing for the buy and hold to check the buy and hold returns of Tata Steel. So Tata Steel gave us an annualized CAGR of 16.95, which looks higher than the strategy. The cumulative returns was 362. Annual volatility was 36%. Sharpe, 𝐸 stability. Maximum drawdown was 64%. So you can see the difference in maximum drawdown, right? So in our case, the maximum drawdown was, in the strategy, the maximum drawdown was how much? It was 44%. So by applying our strategy, we reduced the drawdown considerably, right? So these are the cumulative returns of the buy and hold, Sharpe ratio of buy and hold. Underwater plot, you can see that it's like 60% here, which is a very, very deep drawdown. Now what I'm doing is that I'm just comparing both these outputs that I've shown you. I'm just comparing it so that we can come with a conclusion, right? So we can see that the strategy gave us a CAGR of 14.93, whereas the asset gave us a CAGR of 16.96. So asset is high, gave us a higher annualized growth, right? But volatility 36% on the asset, but 25% on the strategy. So strategy wins here. It was smoother and less volatile. Sharpe ratio, again we can see an improvement in Sharpe ratio. 61 on the asset and 67 on the strategy. Strategy wins here again. Sortino 89 on asset and 1.01. So again, higher the Sortino, better it is. Strategy wins here. 𝐸 0.26. Again, higher the 𝐸, better the strategy. 0.24 here. Strategy wins here again. Maximum drawdown, again, lower the better. Strategy wins here. And daily value at risk, we would have taken 4.54% risk on a daily basis in buy and hold, which reduced. We are only taking 3% risk in our strategy. So strategy wins here. Omega ratio, again it is higher, strategy wins. Tail ratio, again it's higher, strategy wins. Again on skew, it has almost zero skew, but the skew is 0.9%, which tells us it has more favorable return asymmetry, which is good for us. So now we have done a deep analysis and comparison. And so the final conclusion of the whole exercise is that on a return perspective, the asset marginally outperforms on annualized CAGR. This reflects stronger raw growth during favorable market phases. On risk and drawdown perspective, the strategy clearly outperforms on volatility control, maximum drawdown containment, downside risk measures like VAR, Sortino, Omega. Capital erosion is meaningfully lower in the strategy, which we have seen, right? Equity curve quality, both exhibit similar stability scores. However, the strategy delivers a smoother equity curve. So, this is an advantage when you go deeper into the statistical analysis. Even though the equity plots were showing us a curve very similar, but the statistics shows that the strategy had a smoother equity curve. It had fewer sharp drawdowns and lower volatility and are observed in the strategy. So risk-adjusted performance, it has higher Sharpe and Calmer ratios, indicate better returns per unit of risk. This is very important because, see, both these metrics, whether you talk about Sharpe or Calmer, the denominator is the risk here, right? So we all know that Sharpe is like annualized return minus risk-free divided by standard deviation, which is the volatility part. So Sharpe and Calmer, higher is better. So the adjusted return per risk is better in strategy. The performance is achieved through risk control and consistency, not higher exposure. So what are the summary and key takeaway? It's very simple. While the asset edges ahead of on headline returns, the strategy is structurally superior for capital preservation via lower drawdowns and volatility, superior risk-adjusted performance across market conditions. So this is the idea, and this is how you can use Python and go deep down into your strategy. Whatever hypothesis you have in your mind, you can test it and you can quantify it. That is the most important thing. And once you do the back test and you see, you can also keep improvising it, right? So I'm done with the Python file.
Okay, great work, Vivek. Love your presentation. Okay.
Thank you, sir.
So anybody has any questions? Anybody has any doubts, any question? Anybody, anything, or anybody wants to ask something?
Hello.
Yeah, Ajay.
गुड इवनिंग सर। एक्चुअली मेरा क्वेश्चन ये था कि हम लोग क्या पैरेलली कोई कोर्स रन कर रहे हैं क्या, मतलब पाइथन प्लस एंड आपका ट्रेडिंग, सो जिसको अपना क्वांटिटेटिव ट्रेडिंग में करियर परस्यू करना हो तो वो कर सके ताकि।
See, we coach for CMT, right, in yoga, and we
हाँ जी।
also are coaching for Python. Okay. So, CMT, maybe you may not be aware of it. Are you aware of CMT?
या आई एम अवेयर ऑफ दिस। एक्चुअली आपने जो लास्ट सेशन लिया था ना सीएमटी का, लास्ट वीकेंड पे लिया था, वो मैंने अटेंड किया।
Okay, you have attended that. Okay. So these are two things which we do as of now. We coach for CMT and we coach for Python. Okay. So in CMT we
जिनसे
cover all these
हर्ष, उनसे
indicators and chart
हाँ,
patterns and all
मिस्टर
those
हर्ष है,
things.
उनसे मैं कनेक्टेड हूँ।
Okay, got it. Okay.
हाँ
Great.
जी।
So basically, in CMT, we cover all these topics of moving averages and indicators and all the tools, right? And in Python, we basically cover the systematic part of trading, which is like coding part. So in CMT, see, coding is not taught, right? So that is taught in this course, right? Which is Python for trading, or our course is called Trading Transformation Program. So Python coding is covered in that. So if you do both, then mostly you are basically covered what you want, right?
ओके ओके
Okay. But if you want to
ओके।
start, then start with CMT. Okay.
ओके
Because in coding, like what will you code if you don't have an idea? Right? As Vivek showed you today, that first you have to have some idea. So when you uh, do CMT, you get a lot of ideas. You get some techniques which you can use and you can like to test them. Right? So basically, you can do like any, let's say, even after level one, you can join Python because at least you have started getting some ideas, right? Once you have done at least level one, you have some ideas, you know how the indicators are constructed. So that at least that much basic technical access knowledge is required for this Python course.
Hello.
Yeah.
Sir, your
ओके सर,
video is
थैंक यू।
Uh,
Sorry.
from where can we join the trading transformation program?
Okay, it's there on our website. Or we can, if you're interested, we can give you the link of the website. You can join from there.
Okay, so is it on Yuga's official website?
No, 𝐒𝐩𝐞𝐫 website is different. It is on Trading Heads website,
Okay.
tradingheads.com.
Okay, thank you so much.
Can we use this one for option trading? Live
Yes.
option, like basically the system itself can put the buy sell live online.
Yes. All that is done in Python. But like what I would say is that you will so the course right now what we are introducing is the foundation of Python, right? Trading transformation program. So let me share my screen. Let me talk about this program first, and then I'll answer your question about options trading, right? So I hope you can see my screen. So this is the program, right? In this we'll cover the introduction to Python, then data structures and programming basics. Then we'll cover the market data and visualization aspects, NumPy for trading, how to import these libraries, pandas for trading, right? And then statistics and technical analysis principles, trading strategies and backtesting, portfolio and risk management. And we'll also introduce a class on your data, your integration of with the broker, right? So that you can execute your trades directly, right? So all this will be covered. This is a 9-week program, okay? And uh, what the basic requirement is that you need a computer, obviously. Everything is online, so hands-on coding will be done during the session, right? It will be like a 54 hours session, which will be like 3 hours will be each session will be of around 3 hours, and we will be doing it 2 sessions per week, so around 6 hours per week, right? So total there will be around 54 hours, approximately 50 to 54 hours approximately will be there. It can go and exceed a little bit more also, but generally we have seen that it is completed with around 50 to 54 hours. Okay. Reference notes, everything will be given. Home exercises and assignments will be given. MCQs, quizzes will be there. So we will take an exam. We will also take a final exam, right? So that we can evaluate your whether the core concepts have been cleared or not. And then we'll do complete hand holding, right? And then we do give you a certification of completion as well, right? The start date of this program is 3rd January, that is Saturday, right? It will be online class, 3 hours each. Saturday 6 p.m. to 9 p.m. and Sunday 10:30 to 1:30 p.m. Price is 47,500 rupees, right? This is the foundation course, as I said, and then after this we'll also have a advanced course. So in this course, basically your cash market trading, your futures trading, up to that part will be covered. You will be able to make systems. If you follow it properly, you should be able to make systems in cash market and futures, because futures is not much different from cash. The only difference is the leverage, right? Options part will be covered in the advanced course. So we will have another course, which is advanced course after this, right? For options, you'll have to do this course plus the advanced course. Right? You cannot directly come to advanced course because without understanding the basic of Python, advanced will not work, right? You'll have to be good with the basic coding first. Okay? Any doubts? If you want this PDF, we can share with you. The instructors for the course will be Vivek Jain, which who gave you the session right now, and I will also be part of it. Okay, and but
Uh,
mainly it will be handled by Vivek. Yeah.
so anyone who is not having any basic knowledge of Python can also able to learn from this course.
Yeah, that is the purpose of doing this, is that uh, yeah, we start from the groundwork, right? From basic syntax of Python to importing libraries. So all those things will be starting with basics only.
Okay.
But little bit of market knowledge is required, like little bit of technical analysis,
Yes.
basic technical
Yes.
analysis. If it is there, then it is always an advantage.
Okay.
Anybody has any questions, any doubts? Okay, this is starting from 3rd of January, so today is 23rd. So after 10 days, this will be starting. So anybody who wants to join can join it. The question chat box. Okay, thanks, Vipul. Anyone has any doubts? Want to say something? So if you are interested, you can connect with us on this number. Right, Mr. Harsh will be there, right? Or our website, you can directly buy from the website. And another thing is that as of now, you will be getting a 10% discount on this course. Right? So those all those who have joined to this session will get a 10% discount. Right? Just contact Mr. Harsh. He'll give you a how he wants to how we'll give you 10% discount. That we'll discuss. You just call him and we'll give you a 10% discount. उसके लिए ओम गुरु कृपा बिल्डिंग कौन सी है यही है यही अकेला कौन ज्यादा मालूम नहीं वॉचमैन से पूछो वॉचमैन किधर से आएगा वो बाहर होगा हेलो videos will be available online for future reference. Yes, you will get access to 1 year access to the videos. So all the sessions will be live, and you'll get 1 year access to all the videos and all the four course content also. So let me it will be similar to Yuva, those who have those who are our student. The the portal will be very similar to Yuva only. Okay. So, yeah. Okay. I hope you can see my screen. Right. So basically, live lectures from Vivek. So live lectures, my live lectures are also here only. We don't have a separate live lecture. Right. So basically, introduction of trading transformation program first and Python installation. Then again, we did a introduction to trading transformation program. Okay, it was like 2 sessions were there, and then the all these things are there, right? So all the sessions are there here. All the files, whatever is required, they are uploaded here, so you can download these files, right? You can download these files. Okay, class files also, if you see, you can download these files. All these will be required. Okay, and then notes also, you will be able to see here. Okay. So whatever the notes of for installation and all, it everything will be uploaded here. Assignments are also uploaded here. You can see all the assignments are uploaded here. Data files are uploaded here, right? Okay, so you can see data files you can download, data files you can download from here. Right? So all this everything will be there on the portal, right? So you will have access and you can download them anytime in future also, right? Okay. If anybody has any doubts, you can ask. Uh, fine. So I will wind up this session now. As we wind up today's session, the key takeaways is simple but demanding. Markets reward simple and structured, discipline, and repeatable processes, not opinions and shortcuts. What you have heard today is not theory for the sake of theory, but a way of thinking about markets that can be tested, refined, and applied consistently over time. On behalf of the entire team of Trading Heads, thank you for your attention, your questions, and your engagement. A sincere thank to Mr. Vivek Jain for sharing his experience and insights with us openly. Learning does not end up with this webinar. The real work begins when you go back, apply these ideas objectively, and build your own framework, build your own systems with patience and accountability. We appreciate you being part of this session and look forward to continuing this learning journey together. Thank you everyone for uh, connecting. Okay, session for register, you can contact Harsh on Yuva's number, right? You must be having his number, right? So he'll guide you, right? Today is quite late, so tomorrow you can connect with him. Okay, so we'll wind up here. Thanks, Vivek, for the session and your time.
Yeah.
Okay.
Thank you, sir, and thank you everyone for joining. I hope you got some good insights.